If you've been watching the crypto charts over the last couple of days and thinking something doesn't quite add up here, you are not alone. Because on one side, we've got a pretty messy macro backdrop. We've got rising tensions in the Middle East, oil pushing higher, inflation risks creeping back into the conversation, and central banks that realistically don't have full freedom to start cutting rates aggressively again. And yet, crypto is moving up. Bitcoin sitting around the mid 70Ks, altcoins starting to wake up, and sentiment shifting, even if only slightly. So the question is, why now? Is this real? Or is it the market just reacting to a story that hasn't fully played out yet? Because if you've been on Twitter or TikTok or anywhere in the crypto space recently, you'll have seen a few different explanations floating around. Some people are saying this is because Trump is pushing for lower interest rates. Others are pointing to new housing policies and liquidity being injected into the system. And then there's another narrative that keeps popping up that war is somehow bullish for crypto. Now, that last one is interesting because you've probably heard it before. War is good for crypto. And when you hear that, it kind of feels like it makes sense on the surface. Because the logic goes like this. War leads to more government spending. More spending leads to more debt. More debt eventually leads to more money printing. And if more money gets printed, assets like Bitcoin should benefit. And look, that logic isn't completely wrong. But the problem is it skips a step. Actually, it skips a few steps. Because what happens first during times of conflict isn't liquidity, it's uncertainty. And uncertainty changes how money behaves. Oil tends to rise, inflation fears increase, the dollar often strengthens, and central banks become more cautious, not less. So instead of money immediately flowing into risk assets like crypto, you often get hesitation first. Volatility, tighter conditions. So when people say war is good for crypto, what they're really talking about is what might happen later, not what actually happens right now. Because over time, yes, prolonged conflict can lead to more spending, more debt, and eventually more accommodative policy. And that environment can become very bullish for crypto. But in the short term, we're not quite there yet. Right now, the market is still reacting to the shock, not the solution. So, if it's probably not just war, let's look at the other side of the story. Because there is something else happening here, and it's coming from policy. More specifically, the idea that financial conditions might start easing again. Now, recently, Trump has been very vocal about wanting lower interest rates. He's openly called for cuts. He's pushing for action. And even though he doesn't directly control the Federal Reserve, that kind of pressure matters. Because markets don't move on what has happened, they move on what they think might happen next. And when traders start to believe that rate cuts could be coming, even if they haven't arrived yet, they start positioning early. Now, alongside that, there's another piece of the puzzle that most people aren't really talking about properly. And it sits right at the centre of the US financial system, Fannie Mae and Freddie Mac. Now, don't worry, we're not going to get overly technical here. At a basic level, these are government backed institutions that buy mortgages from banks. And when they do that, they free up cash for those banks to go out and lend again. So, if their activity increases, that's not just a housing story, that's a liquidity story. Because it means more money is moving through the system, more lending, more credit, more flow. And even though that doesn't go directly into crypto, it changes the environment that crypto exists in. Because crypto doesn't need money to come straight into it, it just needs conditions to become easier. But here's where it gets interesting, because when you zoom out, these two narratives don't actually fully agree with each other. On one side, you've got political pressure for lower rates and signs that parts of the financial system are being supported, which leans towards easier conditions. But on the other side, you've got rising oil prices, inflation risks picking back up, and a global environment that could actually make central banks more cautious about cutting too quickly. So, what you end up with is tension. And markets do not like tension, they react to it. They swing between narratives, they move fast, and sometimes they move before the data confirms anything. And this brings me back to what I think is probably the most important part of this entire move. Sometimes a pump isn't about a clean macro shift, sometimes it's about positioning. If a market gets too bearish, if too many people are expecting downside, if sentiment gets stretched too far in one direction, then all it takes is a shift in narrative, or even just a pause in bad news, and then price can move quickly the other way. Shorts get closed, buyers step in, momentum flips, and suddenly you've got a move that feels bigger than the actual catalyst behind it. So when you pull all of this together, what's the most realistic explanation? It's probably not just one thing, it's a combination. You've got the market starting to believe that rate cuts could come sooner than expected. You've got signals, even if indirect, that parts of the financial system are being supported. You've got a market that was already leaning bearish. And you've got a macro backdrop that, while still messy, hasn't escalated further in the last couple of days. And that combination is enough to create a move like this. But here's the key part, and this is what I'll be watching next. If this move is real, if this is the start of something bigger, then the rest of the macro environment needs to start confirming it. You'd want to see yields stabilising or coming down, the dollar softening, oil calming rather than continuing to push higher, and central banks sounding less restricted. If those things start to align, then this could be the early stages of a broader shift. But if they don't, then this might just be a relief rally, a fast move driven by expectation, not confirmation. And that is really the takeaway here. This crypto pump might not be about crypto at all. It might be the market trying to decide what comes next. Does liquidity return? Or does inflation keep things tight? Right now, crypto looks like it's betting on liquidity. The rest of the market isn't fully convinced yet. If you enjoyed this video and you want more content that actually connects crypto to what's happening in the wider world, not just headlines, make sure you're subscribed. And as always, if you want to know the exact strategies we use in the Crypto Wolfpack to make money in both the bull market and the bear market, we've made a completely free course for you. It's called the Crypto Liftoff course and the link is in the description below. Thank you so much for watching and I'll see you in the next one.